China's stock market has been an area of both incredible intrigue and frustration in recent years. Put simply, equities in the world's second largest economy have underperformed materially since 2021. Most listeners would be aware of the regulatory and economic fear that grip markets, perhaps most notably headlined by troubles in China's property sector.
Embattled Chinese real estate giant Evergrande has been ordered to liquidate.
The broader hope is that by turning around the property sector, the government can get consumers to spend again.
Sentiment's been very negative, but it started to turn at the beginning of the year, and recent announcements suggest policymakers are becoming more serious about stabilising the property sector and the equity market. Joining me today to discuss Chinese equities is Antipodes portfolio manager John Stavliotis. Welcome back to the podcast, John.
Hey, Alison, it's good to be back on the podcast.
John, you've just returned from a few weeks meeting companies and market commentators in China and Hong Kong. What was the feeling on the ground?
Yes, so one of the things I thought was interesting and somewhat surprising was the significant increase in participation by foreign investors, and not just at the conference, but at a lot of the meetings and tours that we participated in. There are a lot of people from Europe and the rest of Asia, which really were quite absent from the trips we've done recently. So this was the third trip to China in the last 12 months. That was actually good to see. Another observation was just onshore investors remain very negative. They've been through, as running direct China funds and been through a period of quite tough performance and, equity outflows, etc. So that sentiment remains negative. And then sort of just on the general feedback of, walking around Shanghai, Shenzhen, Hong Kong, etc., the shops, the environment remains quite vibrant. So it's not as negative as we like to think about it.
And what about the meetings themselves? What were your key takeaways?
Yeah, so everyone's minds, and I think everyone listening to this podcast, if you've clicked on the China-themed podcast, would be questions around property, macro, and policy, and that was the key topics of conversation. The macro certainly remains weak, particularly relating to consumer, but there are some signs of green shoots, and particularly around the confidence in the policy direction. There was more positivity on some of the structural opportunities emerging in the country. For example, localization, some export opportunities, what I'd sort of call the creation of emerging market champions. Investment in power grid was something that, was quite positive. And then lastly, we heard a lot about, shareholder value creation, whether that's increasing dividends, better allocation of capital, much like what we've seen in Japan and Korea. This started with the SOEs, the state-owned enterprises, but it's now certainly expanding to the private sector.
So what about let's spend a bit more time on the 20% of GDP sized elephant in the room, the property sector. Concern over developer default risk has had a huge impact on consumer confidence, which has bled into broader economic weakness. Now, we've talked about this playing out as an L-shaped recovery, with new sales stabilising at around 8 to 9 million units a year, which compares to 16 million at the peak. But when do we get that pivot point?
Yeah, you're right. We've not reached the pivot point, and that's been one of the areas of disappointment in the China property market. And new sales continue to decline, as do prices. The key shift that's happened in the last month, and it sort of really started at the last Politburo meeting, was that the government's intention to manage or clear excess inventory in the system has become a key topic. And, the word destocking was used for the first time since 2016 in government communications. There's very deep analysis of government communications in China, and that's one of the words that's been highlighted. There are many initiatives that the government's trying to do to achieve this, and that's things like getting local governments, SOEs, and other entities buying inventory and converting that to rental, social housing, or even just providing funding to allow discounts to actually get natural buyers to come back and make the transaction. So on this trip, we consistently heard from management and experts that we spoke to that quite confidence in this policy direction, albeit I'll say that they're not confident that there's enough action taken just yet, but they are confident in the direction, which I think is a big shift. And there are some early signs of success as well, right? So if you look in the last month, we track a lot of this data that there's been a good response from the market. So foot traffic at display suites has been picking up. We heard a lot of evidence of premium end, especially in Tier 1 cities, showing actually some strength. Like one developer we met launched a project in the premium area of Shanghai that sold out in 24 hours. Owner-occupier demand is picking up, but investors have not returned to the market. The other one is the secondary market, so purchasing existing homes. And most people won't know that actually was up 30% last year, and the 2023 existing home sales in the top 17 cities was higher than 2021. So that's been trending quite well for some time, but that is also now getting back to growth even on the high point of last year. So that's some of the data that we're tracking very closely, but there's some positive initial signs there.
Do you think we could be near the bottom in new sales? And what does that mean then for the broader economy?
Yeah. So we think in terms of pricing, we think that house prices will bottom in the near future. And prices are down, call it 30 to 40% in lower tier cities and 20 to 30% in high tier cities. So we've had a massive correction, but we think this shift to destocking will stabilize pricing, which is very important. So we're stock market investors, not property investors, but remember that an inflection in pricing will negate that deflation spiral argument that has been a significant overhang on equities. So that's why we're looking at that very closely. Stabilization in pricing will have a big influence on consumption and household credit growth. So we estimate that about 60% of household wealth is tied up in property. It's not too dissimilar to Australia. So any improvement in pricing will help consumer confidence, and there's significant pent-up demand because one of the numbers we track is household deposits, and we estimate there's about $4 trillion in excess deposits above what would be the normal trend of savings since the beginning of COVID. So this is huge firepower if there was a significant improvement in confidence. So to be clear though, despite those green shoots that I just mentioned in the secondary transactions and high-end Tier 1 or owner-occupiers, we're not seeing a significant improvement in the consumer segment just yet. And it's it is quite selective areas that are showing resilience or strength in consumption. One of the other interesting observations on consumption is that the Chinese consumer is becoming more educated on where they're spending. So really looking out for quality and at affordable prices. So this is a positive for some of the more local Chinese brands. But yeah, I sort of detracted from the topic there. But really the point I'm trying to make that is if property prices do stabilize, it will lead to a broader improvement in the consumer segment.
Is there a risk though that the malaise in the property sector, just continues longer than what you would expect, than what you're expecting?
Yeah, look, the biggest risk to property remains policy error. And like I said, we don't think enough has been done just yet. The direction we've got more confidence in the direction. So that risk still remains fairly high. It could come from insufficient funding by the central government or reluctance by some of the SOEs and local councils. But what's interesting in the last month, since this turn towards destocking, on a daily basis, you're seeing more comments from like the PBOC or other central government bodies that are pushing this agenda. So really what I'd say is it's going to be a bumpy recovery, but it does seem that we're on the right track. So it's very important to be watching that weekly transaction data that I mentioned, and watching the policy announcements by either government or government bodies.
Okay, so pulling all that together, you're becoming more confident on recovery in the property market, but there are still risks. So investors need to be very selective. So then how are you thinking about all of this in the portfolio?
Yeah, so I'll give you like a stock example. So KE Holdings is a stock that we own. It's a high growth business that we think should do well in this current setup. It's exposed to property in being the largest property portal in China. Think of like the realestate.com of China, but it's got its own nuances, which I'll discuss. They've grown share, and they now have, in the secondary market or existing homes, they've got 35% of all transactions nationwide. And in the primary new home market, they have about 11% of all transactions across the country. Their business model, it's been successful because they run a combination of their own agents. So this is where it's different to REA. They have a combination of their own agents to establish that service standard, and they've got franchise and connected agents to expand their market share. So this model incentivizes all the parties in the transaction according to what they contribute, and this basically leads to a better outcome for both the buyer and the seller. They've got it means that they have a portal featuring the best properties on the market without fake ads that are posted by bad agents that are just trying to grab customers, and that's been a big issue for other platforms in China. So effectively, they've solved one of the big issues in that industry in China. They've got a focus on tier 1 cities, so they've been benefiting from this recent improvement in transactions we've talked about. And one of the long-term structural opportunities we think that this company is exposed to is turnover. So in China, turnover, as in existing home sales to the total housing stock, is only about 1%. And as China moves from this new home, a large new home market, to being a more normal market, like something you see in the developed world, that turnover rate could go up. And in the US, it's 4%. We're not using that as a guide because it is lower in other countries, but just giving you a bit of color on how that could change. And that would be a huge shift, given that they're the leader in the market. They're also offering some services in rental and renovations, and that's a big opportunity because when you buy a house in China, most people do a full renovation. And this company is trading on 15 times PE. It's got greater than 20% growth, and it's got a big cash balance. It's got over 50% of market cap, mostly in US dollars, in cash. The board has enacted a buyback program, and they've given guidance that they're going to return to shareholders a 5% yield on the current share price through a combination of buybacks and dividends. So we see this as a very attractive investment given the current market setup.
Let's shift to some of the more structural opportunities we like in China. The development of China's emerging multinationals is a topic that you and I have discussed on this podcast before. These are domestic champions that have the potential to also become export champions. Now, we've seen the US announce a significant increase in tariffs across a host of Chinese imports like EVs, semiconductors, certain commodities, and even just last week, Europe followed suit with their own tariffs on imported Chinese EVs. So how does this evolving geopolitical landscape impact the way you're thinking about some of these leading domestic businesses in China and their ability to grow beyond their borders?
Yeah. So geopolitics is becoming a big driver of localization, like Chinese companies producing products and services that were previously imported from leading global companies. And, this has been a priority of the government as self-reliance is becoming increasingly important given the tensions. In other instances, such as semiconductors, it's because China's been cut off from, the Western chips, for example, and local companies are forced to satisfy demand, even if it is with this inferior product. If companies can operate in China, it normally means that they'll be very competitive on a global scale. China is a very competitive market in itself, and difficult to become a winner. So it's a good test of how good a company can be at its business. And we've seen this in electric vehicles, but we don't think that's isolated to EVs. So, Chinese companies are unlikely to be able to sell into the US or potentially even Europe, as you mentioned. But there is a large emerging world that would be happy to buy Chinese products if they are cheaper and, as good or better. So, we think there's a situation where Chinese companies could become emerging world champions. And this will be really attractive because you've got higher population growth, GDP growth, and these countries are in earlier phases of premiumization or product adoption. So, that's one of the things that we're looking for is some of these companies that could end up being great proxies for that development of the emerging world.
And what are some good examples of this trend?
So the software industry is a an industry where we're seeing localization play out, and really this is more local at this point. So it's about finding companies that are able to become the local champion at the moment rather than exporting. In that space, we own Kingdee. It's the local ERP software company. Think of it as the SAP or Oracle of China. When we assessed the opportunity for software localization, we found that this company was most progressed in having developed a comparative offering to the global peers in terms of quality of the software solution. That allows them to sell their product at a premium to some of their local competitors. And it also means that they are much earlier in that phase of, shifting to subscription style revenues. And they're also in the process of having a cloud offering for their large customers. We think that they're going to continue to take share over the long term, particularly as they sign up SOE customers who, they're being directed to be using local software where possible. And we think that's a great long-term opportunity as they penetrate that customer base and then further into private companies, which they currently also have private customers. Although, like I said, it's not an export story at this point, but what is interesting is they've attracted a $200 million investment from Qatar Investment Authority as a sort of, key investor, about 4% of the company. And we think that opens up a potential to expand into that country and then potentially the rest of the Middle East down the track. So this company trades at just over 3 times this year's sales. Almost the Western peers, that's almost half of where the Western peers trade. And we think that's cheap given this company's got a much higher growth potential as it's starting at a low base in China, which itself is a high growth market. And we've done a lot of analysis of the earnings power of this business, where they've shown excellent operating cost management. And we think that they've already shown strong evidence of leveraging their cost base. And we see them delivering about a double-digit OP margin in the next 2 years. It's cash flow positive already, and they've been opportunistically buying back shares with the excess capital they've got over the last 6 months. So this is a really interesting sort of local champion that's developing in China.
The other investment opportunity is China's power grid. You mentioned this was an area of discussion during your recent trip to China. Are investors overlooking how quickly China is growing its renewable generation capacity? So, John, perhaps you can start by breaking down China's push into renewables for us.
Yeah, sure. So China has launched an aggressive power market reform. It's been at play for some time, but in the last year, they've really eliminated any question of the government's seriousness regarding this effort. So in 2023, 250 gigawatts of solar was added to the grid, that's about 65% of all the solar capacity added across the world. And another interesting stat, if you look globally, At the end of 2022, there was only 1,100 gigawatts of installed capacity globally. So in that 1 year, they almost added just under 25% of total global capacity. On top of this, there was about 75 gigawatts of wind added. So we're on track to meet the 2030 target of 1,200 gigawatts of installed wind and solar capacity by the end of 2024. So that's really ahead of what the plan was. So I guess I'm going to preempt a question in that, why is this actually happening right now? Why has the acceleration happened in the last year? So there's a few reasons. Firstly, it's about the economics. Wind and solar is now cheaper than coal power generation, particularly if it's generated in the northwest of China, near the Gobi Desert, where many of what they're calling renewable energy bases are being constructed. So effectively, an area where there's high efficiency is where the power will be generated, and then it'll be distributed, to North Coast or Central China where it's consumed. The fully transported cost is about $40 per megawatt hour, and that compares to the current coal tariff of $60 to $70. So it's a big differential, and that's without subsidies. So China eliminated all subsidies on new solar and wind back in 2021. Secondly, lowering the effective cost of power is basically going to help China's competitiveness on a global stage. And this is very important, especially as the country is trying to, looking towards high-end manufacturing as a key driver of growth as property becomes less important. So to put this into perspective, we estimate that China has already got a lower total cost of power. It's about $88 per megawatt hour, and that's the all-in cost, including generation, distribution, and grid. And that compares to $120 in the US. So, rolling out renewables at a cheaper cost will just further improve that advantage. Thirdly, investment in the grid, it's a kind of economic stimulus, right? That's going to drive GDP growth in the near term, especially as that property contribution declines. So again, very simple arithmetic. There's 5.7 billion megawatt hours of coal-fired power generation. And if that were to all be converted to wind and solar, which is not realistic, I'm just trying to put it into context for you, this would require $2.5 trillion of investment. So that's a big driver of growth for the GDP that, obviously that's an inflated number that I'm mentioning, but I'm giving you the scale of a total conversion. And then lastly, President Xi has on many occasions stressed, energy security and self-reliance, and, renewables is one of the ways this can be achieved.
That's really interesting, John. And some of those numbers there that you called out, it does make economic sense to do this from a number of factors, whether that is whether it's shifting to greener energy, which we need to do, whether it's cheaper source of energy, and the fact that it does create this can create this boost to economic activity. So then the question is, why isn't everyone doing this? Building out renewable energy to lower power costs.
Yeah, look, I think most people would be surprised to learn that China's power grid is far more advanced than the US or Europe's, which were mostly built in the 60s and 70s and have not had much investment since. So there's a solid base from which China can more effectively build renewable capacity. So it allows them to build assets in areas that generate a better efficiency rate, and then get that to the population or where the electricity is actually used. But I do want to highlight more investment in the grid in China is needed as this capacity build out goes on. So you'll see, particularly things like ultra high voltage transmission, grid digitization, etc., will be things required even in China. The second reason China has an advantage, I guess, in this renewable build out is, China can be much more effective at implementing policy when it's a directive that comes from the top, which it clearly is right now. As I mentioned earlier, President Xi has been stressing energy security and power reform as a key objective. Actually, just last week, a book was published in China highlighting President Xi's thoughts on power reform, which highlights the importance of this topic from the highest level. Right now, look, this level of prioritization should ensure that some of the issues that have been happening at a provincial level, like investment in the long UHV distribution, etc., will get resolved very quickly. And we'll see that build out continue. So, if we compare to the US, which is what we normally do when we think of these sort of things, we've seen a lot of delays in renewables there, mostly around disputes amongst state governments or funding of projects. But I would say if President Biden does win the election later this year, we probably will see more of a prioritization in this grid build out and further investment. So that could see a bit of an acceleration in the future in other countries.
Okay, so you've set the scene for us in China. How are you positioning for this in the portfolio?
Yeah, so we're taking exposure via a collection of stocks, really to get an exposure to development of the grid. So the one I'll mention in a bit more detail is NARI. It's the largest of our holdings, but we also invest in a number of companies that are more directly exposed to the build out of UHV lines, ultra high voltage lines. And that's important because that's where we see the biggest sort of delta of change required because of this build out of renewable bases, up in the northwest of China. So that's where we see a larger delta and we're taking a bit more of a directed investment. But back to NARI, which is the largest of these holdings at the moment. Look, NARI is an SOE. It's the R&D center for the state grid. It leads in the development of the modern grid equipment and technology solutions. So basically, they focus on grid automation, communication solutions, dispatching software, as well as offering the associated secondary equipment, so the hardware that protects and monitors the grid. So as renewable gets built out, NARI's solutions will be in high demand. For example, with more renewables, you need to upgrade the power dispatch system so it collects and analyzes the data better, effectively, a simple way to put it. This company is growing revenue at circa 10% per annum, and earnings are growing at mid to high teens. And that's because the margin is improving because more of the revenue is coming from this grid digitization and UHV build out in our estimates, and that revenue is higher margin and more profitable. This stock's not at a very low PE multiple. It's trading on 20 times PE, but we think that's an attractive valuation given it's got very resilient earnings. It's consistently grown at the rates I just mentioned. It's got a lock on, its key supplier of work, as in the state grid. It's the R&D center of the grid, and the exposure that we're talking about. It's got a long-term growth opportunity, and like I mentioned, that higher growth is coming in areas that are more profitable for this business. So we see this as a very resilient growth business that is trading at a valuation that we think is cheap for what you're getting.
So before we finish up, John, throughout this discussion, you've touched on companies, and you've used language around buying back stock and increasing dividends. So a focus on improving shareholder returns is something, that we are seeing in, as you mentioned, in Japan and Korea, but it's also coming through in China. So just the quick 30 seconds, how is this reform evolving in China?
Yeah, look, this sort of started with the SOE reform, where basically KPIs of SOE management are really focused on generating a higher return on equity, and that's even evolved now to what they're calling market cap management. In other words, one of the KPIs is to get the share prices up. So, and that's a distinct shift to the old days of SOEs being told to hire more people or do sort of national service sort of projects, right? And I think what it is, it's it's a shift. It's a result of basically China further down its development path, right? You do have, the population is aging. Your growth opportunities aren't as high as what they were 10, 15 years ago. So now you actually need companies to be focused on putting their money where they're going to generate a higher return on equity, improving shareholder returns so that wealth gets generated in the population. So the market's responded very positively to this, and some of the best performing stocks have been these, higher dividend yield stocks over the last 6 months. And, this is now flowing through to private enterprises. We've seen it across a number of our holdings and across the number of names that, most listeners will know, like Alibaba, Tencent, etc. They've all been very active in their buybacks, and a lot of them are now paying a regular distribution, which is something these companies that used to consider themselves growth companies never did before. And, the number I like to highlight is, in the 12 months to the end of March, Alibaba returned 8.5% of shareholder return yield through dividends and buybacks. So it's a pretty significant return.
Okay, John, to wrap this episode up, my high-level summary from listening to everything that we've discussed today is that the Chinese economy is still under pressure, but the policy direction is improving. There are some cyclical opportunities and, for example, what we've discussed in the property sector. And there's also some interesting structural opportunities. So, what we discussed around the development of these local champions and investment in renewables in the grid. And this is against a backdrop of still relatively weak investor sentiment and low valuations. So it does feel like a unique valuation opportunity. The big question is, can the Chinese market thrive again? What's your final takeaway?
Yeah, look, I think it can, and arguably parts of the market already are. Like we said, that the macro is not really firing at the moment, but this kind of market we think has opened up opportunity to invest in some, businesses that have shown strong resilience and shown growth through a difficult period at very attractive valuations. If you think of our portfolio, I'd sort of put it into 3 buckets. I'd say there are sort of what I'd call lower growth, resilient, stable businesses that, are showing improving shareholder returns that are trading at very low valuations, for example, Alibaba. I'd say the next bucket would be the high growth companies that are very cheap for the resilience and growth in their operations, for example, Tencent or KE Holdings. And then there's the bucket of what we'd call structural opportunities that, aren't, cheap on a next 12 months PE multiple, but we think are very cheap given the long-term structural opportunity they're exposed to. And that would be the grid, the, Kingdee, or in the semiconductor space in China. So that's how we're positioned. And we continue to think that this is a very attractive time to be investing in these companies.
That's great. Thank you, John. As always, thank you for your viewpoints from on the ground in China and your insights into Antipodes portfolio positioning.
Thanks, Alison. It's great to be back on the podcast. Thank you.
For further information on Antipodes, head to our website, antipodes.com, and you can also follow us on LinkedIn and Twitter.
The content in this podcast is general information only. It is not advice of any kind and doesn't take into account your personal financial situation, objectives, or needs. You should seek professional advice before making any financial decisions. Stock commentary is illustrative only and not a recommendation to buy, hold, or sell any security.